So the Fed raises interest rates again by 0.75%, and it has a significant impact on mortgage rates, but not in the way you think. Most people think that mortgage rates go up because the Fed raised their rate. The truth is, mortgage rates went up 2 months ago in anticipation of the rate going up this week. But here's what's critical. What's critical is, what did the Fed say about the future of rate hikes, the future of inflation, and the future potential recession? And the Fed's not being very clear about it. What do I mean by that? Well, here's the deal. When the Fed first came out and published their announcement on Wednesday afternoon at 11 o'clock Pacific time, the stock market loved it. The mortgage market loved it. Everybody was happy because the Fed said we're slowing down our rate hikes. And everybody's super excited because as soon as the Fed stops hiking their rate, it says to the rest of the world, the Fed thinks inflation is under control. And at that moment, the worry shifts from inflation to recession, and recessions drive mortgage rates down. So we have to watch the tea leaves and figure out what the heck is the Fed thinking. So for 30 minutes between 11 and 11:30, everybody's celebrating. Oh my gosh, it's great. The Fed's finally slowing down their rate hikes. And then Chairman Powell comes out at 11:30 and pours water on the celebration and says, nope, here's the deal. We're still going to raise rates a lot. We're nowhere near done. We're going to raise rates a whole lot more. Here's what I think. I think that the Fed's kind of acting like your parents acted when you're driving somewhere and dad's driving along and you're screaming in the back seat and dad says, don't make me pull over this car. The truth is, dad really has no intention of pulling over the car, but he's threatening you. And he's threatening you because he wants an intended outcome. He wants you to stop doing what you're doing. But the truth is, dad's stuck in traffic and he's going to be late if he pulls over the car. He's not pulling over the car. As an adult, we know that. But as a child, we don't. The Fed is treating us like a child. The Fed is saying, look, in writing, they're telling the truth because that's kind of what they have to project the truth in writing. And they're saying, we're going to slow down our rate hikes. We think we're getting close to the end. But they don't want the markets to act like that. That's what happened back in June. Back in June and July of this year, up until really mid-August, the Fed gave the indication to the economy that, hey, we're kind of pausing, slowing down. It's not going to be a big deal. Our rate hikes aren't going to be as big as what we thought. And everybody started relaxing and spending like drunken sailors, which is what increases inflation. And the Fed is trying to not have inflation go up. And so until inflation is gone, the Fed has to keep telling us they're afraid of inflation. So does the Fed commentary impact mortgage rates? Absolutely. But is it a direct correlation? No. What we're going to have to see is where things go. Right now, we're also dealing with the jobs question. We have a big, a big challenge because it feels like we're in a recession, and yet the jobs numbers aren't going down. And I actually thought of something this morning that I think might be happening, and it has to do with a scarcity mindset. Scarcity says, I'm afraid. I'm afraid of what is going to happen about things I cannot control. And scarcity specifically regarding employees and availability of people to come to work for you. We've spent the last 2 years having a scarcity of people willing to work because we were paying a significant amount of unemployment. We had people who couldn't or wouldn't leave their home because of COVID, and we had a shortage of workers. Now employers have enough workers, but they're still hiring more. They're kind of worried, like, man, if there's somebody available, I might as well hire them just in case. The problem is the output of a lot of companies is stagnating, and it's going to start going down, even if it stays the same. If you're hiring more workers to do the same amount of work, those people are sitting around doing nothing some of the time. And that's actually inflationary because it's costing you more money. It's costing it's costing the company more money to produce the same goods. And those companies are holding on to people because they're afraid they won't be able to find somebody. But at a certain point, it's going to break. The dam's going to break, and employers are going to realize, you know what? I just can't afford to hold on to people just in case. I got to have faith that I'm going to find people when I need them, but I can't spend money on staff that I don't need. Kind of the same thing's happening with office space. I can't spend money on office space I don't need. That is ultimately where it's going to go. Right now, they're kind of holding on to the office space and saying, well, we might have our employees come back to work. We might not. There's a lot of unknowns right now. And it's creating people to kind of pull back and say, you know what, maybe I'm going to keep my office space. Maybe I'm going to keep these people. And so unemployment will start to tick up. The Fed sees unemployment going from around 3.5 right now to 4.5 by the end of next year. That means we're going to see a pretty significant increase in unemployment, but we're not seeing it yet. And that's keeping the Fed worried about inflation, because if people are paying more employees to produce the same number of goods, they have to charge more for the goods to pay for those employees. That's going to keep driving inflation, which is exactly why mortgage rates keep going up. It's exactly why the Fed has to keep their foot on the gas pedal, pedal to the metal, continuing to raise interest rates until inflation is under control. Thanks for listening. Hope you have a wonderful weekend, and we'll talk to y'all soon. Bye-bye.